If you follow financial news at all, you've probably heard this phrase repeatedly: interest rates are rising. And usually the tone of the news sounds something like this: concerned, urgent, maybe even a little dramatic. Apparently, higher interest rates are supposed to be terrible for investors. But is that actually true? And more importantly, what do rising interest rates really mean for investors? Because like most economic topics, the reality is more nuanced than the headlines suggest. At Simply Speaking About Money, we follow a simple framework: budget, save, invest. And when we invest, we focus on probabilities rather than possibilities. That means understanding economic changes like interest rates, but not allowing headlines to derail long-term investing strategies. Interest rates influence almost every part of the economy: mortgage rates, credit cards, business loans, government borrowing. When interest rates change, the cost of borrowing changes across the entire financial system, and that ripple effect eventually reaches financial markets. Interest rates typically rise when central banks try to control inflation. When inflation rises too quickly, central banks increase borrowing costs. This slows spending and borrowing across the economy, which can help reduce inflation pressure. It's basically the economic version of tapping the brakes. Higher interest rates can help control inflation, but they also tend to slow economic growth. Businesses borrow less, consumers spend less. Housing markets cool down. That's why financial markets often react strongly when rates rise. Before we continue, if you enjoy practical financial education without hype, subscribe to the channel. Here we focus on budgeting, saving, and probability-based investing strategies designed to build wealth over the long term. Because financial success rarely comes from chasing headlines. Higher interest rates can affect stocks in several ways. First, borrowing becomes more expensive for businesses. Companies that rely heavily on debt may see profits shrink. Second, investors may shift money towards safer investments like bonds when yields increase. This can reduce demand for stocks in the short term. Growth stocks often feel the pressure of rising rates more than other companies. Why? Because their valuations are often based on future earnings. Higher interest rates reduce the present value of those future earnings, which can cause growth stock prices to decline. When interest rates rise, bond yields typically increase. This makes bonds more attractive to some investors, especially those seeking income. This shift in investor preferences can temporarily reduce demand for stocks. Interest rates also affect the housing market. Higher mortgage rates increase borrowing costs for home buyers. This can slow housing demand and reduce price growth. Real estate investment markets may also adjust accordingly. Because of these factors, rising interest rates can create short-term volatility in financial markets. Stocks may fluctuate as investors adjust expectations about economic growth and corporate profits. But volatility is not unusual. It's simply part of how markets react to changing conditions. Interestingly, rising rates sometimes signal economic strength. Central banks usually raise rates when the economy is strong enough to handle it. That means businesses are growing, employment is strong, consumers are spending, so rising rates are not always a negative sign. Long-term investors understand that interest rates move in cycles. Rates rise, rates fall, economic conditions change. But over long periods, diversified markets have historically continued to grow alongside economic progress. Diversification remains one of the best strategies during changing interest rate environments. Different sectors respond differently to rising rates. Financial companies, for example, sometimes benefit from higher rates. A diversified portfolio helps balance these effects. Companies with strong balance sheets and manageable debt tend to handle rising interest rates more effectively. Businesses that depend heavily on borrowing may struggle when borrowing costs increase. Strong fundamentals matter even more in higher rate environments. Investment costs always matter. But during periods of slower market growth, high fees become even more noticeable. Many investors focus on low-cost index funds and diversified ETFs to minimize expenses. Lower costs help preserve long-term returns. Trying to predict the perfect moment during changing interest rate cycles rarely works. Instead, disciplined investors continue investing consistently. Regular investments allow investors to accumulate assets over time without relying on market timing. Automation can simplify this process. Automatic investments continue regardless of market headlines. No emotional reactions, no hesitation, just consistent investing. Compounding continues working regardless of interest rate cycles. Returns generate additional returns over time, but compounding requires patience. Investors who remain disciplined allow long-term growth to accumulate. Financial media often treats interest rate changes like breaking news emergencies. Rates are rising. Markets react. But for long-term investors, these changes are simply part of normal economic cycles. Economies expand and contract. Inflation rises and falls. Interest rates move accordingly. These cycles have occurred repeatedly throughout modern economic history, and markets have continued adapting over time. One of the biggest differences between successful investors and struggling investors is behavior. Disciplined investors remain calm during market changes. They follow their strategy. They avoid emotional reactions to headlines. If you want more videos about investing strategies, economic trends, and long-term wealth building, subscribe to the channel. We focus on practical financial principles designed to help people build real wealth over time. Because successful investing usually comes from discipline, not prediction. Smart investors don't panic when interest rates rise. They review their strategy, maintain diversification, continue investing, and focus on long-term goals. Rising interest rates can create short-term market adjustments, but they are also a normal part of managing economic growth and inflation. Understanding this helps investors stay calm during market changes. Interest rate cycles will continue. Markets will react. But disciplined investing strategies remain effective across many economic environments. Diversification, consistency, patience. If you found value in today's video, make sure you hit the like button and subscribe to Simply Speaking About Money so you never miss practical strategies that help you build wealth and make smarter financial decisions. Also, check the description box below for the financial tool we recommend related to today's topic. It's a resource we personally suggest because it can help you apply what you've just learned and take action immediately. Your support helps this channel continue bringing you clear, no-hype financial education. Now stay with us, because up next is a special bonus that can help you take this even further. If you want to see your entire financial life in one place, clarity is the first step. That's where Empower comes in. Empower gives you powerful tools to track your net worth, monitor investments, analyze fees, and plan for retirement, all in one dashboard. You can connect your accounts, see exactly where you stand, and make smarter decisions with real data, because what gets measured gets managed. If you're serious about organizing your money and building long-term wealth, check out the link in the description to explore Empower. Affiliate disclosure: I may earn a commission if you sign up using my link at no extra cost to you.